Bristol Myers is down 15% year to date. It offers a healthy forward yield of 3.7%. And what we want to understand is, can we lock in an undervalued price for Bristol Myers with that starting yield and see not only share price appreciation, but also our yield on cost go bigger and bigger year on year, soon to see double-digit yield on cost. We're going to take a look at the historical performance of Bristol Myers. We're going to jump into their revenues, analyze their bottom line as well, that net income. We're then going to look at the health of their balance sheet, look at their total cash versus total debt. This is going to tie in nicely to their dividends and their dividend safety, as well as some very important metrics for BMY. As always, we will run it through our stock valuation method, getting to our intrinsic value and finding out our acceptable buy price given our margin of safety. Now, down 15% year to date. It is at the 52-week low or thereabouts. Does offer what I would call a respectable yield of 3.72%, which I would expect to only grow bigger from this point. And shareholders who have held the company over the last 10 years would be up around 48%. We can see it has been a bit choppy, highs and then lows coming down and back up. So what we want to understand is this towards the bottom end of the local low, and will we be expecting to see share price appreciation as well as some strong dividend yield growth? Well, let's start off with their revenues, and what we like to see is 3 to 7% revenue growth year on year. 22.6 billion reported on that top line, December 2018. 5 years later, 46.2 billion. So some very strong growth, more than doubled over the last 5 years. And we can also see consistent revenue growth, and we will take a look at the 10-year data and percentages shortly. Now, bottom line net income, how does that compare? Well, 4.9 billion reported on the bottom line in 2018. 5 years later, 6.3 billion. Now, that's positive to see the growth, but when we take a deeper look, we can see from 2018 to 2020, it did in fact decrease with a large 9 billion net loss in 2020, and then it did pick up again. But we can see inconsistency. So let's try and understand why shortly and implement that into our analysis. Now, the balance sheet review, typically for a quick health check, what I like to look at is the total cash versus total debt. 2018, 8.8 billion on the balance sheet. 2022, 9.2, with the latest quarterly report coming in at 8.7. So essentially over the last 5 years, the cash balance has remained relatively flat. Let's see how that compares to the total debt. So what we can see here, we can see the total debt coming in at 7.3 billion in 2018 and a significant increase in that latest quarterly report, 39 billion. So just under 6 times increase in the total debt. So we want to understand, how does that affect the company's forecast operations and also that important dividend? Well, straight away we can see the dividend safety score of 79, making it safe. Market cap of 128 billion, making it a mega cap company. Now, for those who believe we're heading into a recession, well, last recession, they maintained their dividend during the 07-09 period. Recession sales were negative 21%, which was in fact below the average growth during the 2007-09 period for the S&P 500, which was also in fact negative. But the recession return did beat the S&P's negative 55%, coming in at 32%. So a mixed bag there in terms of recession previous performance. Now, they did increase the dividend 5.6% over the last year, December 2022. Last 5 years, in fact, 7% dividend compounded annual growth. Last 20 years, 3%. Now, the reason why I find 3% underwhelming is because inflation over the last 40 years in the US was 4%. Anything less in your dividend, salary, other income producing assets, you are taking essentially a dividend, a pay cut, losing your purchasing power. Now, in terms of the growth, the dividends have been growing year on year for the last 16 years, which is positive to see. Now, dividend yield theory states that a company is undervalued when the current yield sits above the 5-year average. So we can see here 3.72 versus 3.1, one sign of undervaluation. Likewise, forward PE sitting below the 5-year average of 9.4, currently at 7.9, another sign of undervaluation. As always, though, we never look at any model in isolation and draw our conclusions towards the end of the episode. Now, it's also lower than the sector PE of 16.5, and as mentioned, it is there about at the 52-week low. However, we always say 52-week low is not undervalued. Likewise, 52-week high is not overvalued. So, earnings versus free cash flow. For those that are new to the channel, we'd never look at earnings as it is susceptible to manipulation by management through their accounting. We always look at the free cash flow. Now, I like to see below 60% is one of my 7 golden dividend metrics. Check the pinned YouTube video to see the other ones, because it means there's room to grow that dividend double digits that we like to see. Now, one thing just to show you here, 2015, we can see here 74% as the earnings payout. 2015 and the free cash flow, what this is signaling is that in 2015, 193% of the free cash flow generated by the company was paid out in dividends, which is a huge red flag. Now, you could argue that 2015 and 16 is an outlier, but just one thing to note and why we always look at the free cash flow. Last few years, however, 2020, 31%, 2021, 29%, 2022, 39%, and 2023, 28%. So it does give me faith in that dividend being paid and expecting a relatively nice increase this year. Likewise, free cash flow is what we look at per share, 183 in 2013. $5.61 in 2022 with a nice bump to $8.03 in 2023. So very positive, and it's going upwards in that upwards trajectory, which is why I always like to look at least 10 years worth of data, because if you only looked at 5, you may see from 2013 to 2017 very inconsistent. So always bear that in mind when you research stocks. Now, I did say 3 to 7% growth year on year is what we like to see. But if we see here on the large part, fairly inconsistent, a few years of negative, and then some years here between the 3 to 7% we like, plus 1 or 2 years of double-digit growth. Very positive to see. 2022, relatively flat. Numerically speaking, 16 billion in 2013, 2022, 46 billion. So nice growth over the period, nearly 3 times. The one thing I would mention is, though, from 2020 to 2022, there hasn't been too much growth. So it's important to see the forward-looking guidance for 2023 and 2024 before investing. Now, shares outstanding, we love it as essential shareholders where companies return excess cash to us, but through share buybacks. But what we can see here is the complete opposite, 1.66 billion in 2013, 2.15 billion in 2022. So in fact, they're doing the opposite and they're diluting your ownership as a shareholder. So just do bear that in mind, as that would be negative for investors. And one thing I always say, if they've done it once before, they are likely to do it again. ROIC, again, another one of my 7 golden dividend metrics. 10% plus is what I like to see, as it gives me faith in management and their ability to effectively allocate their capital. The last 2 years, above 10%, very positive to see. Likewise, 2013 to 2018. Just bear in mind, 2019 and 2020 look to be a bit rough for the company, so we do see those single digits, but I would expect them to be right back up there at those double digits from 2023 onwards. Operating margins and free cash flow margins, very inconsistent. We like to see above 25% for biotech companies. What we can see, in fact, it has been below that all but 2016. So ideally, we want to be ensuring that 2023 onwards, they are getting at least as a minimum 21 to 22%. Likewise, free cash flow margin, very inconsistent again. But from 2019 onwards, they have been showing some nice signs of improvement. So hopefully, in their forward-looking guidance, we can see some nice signs of improvement. Finally, net debt to earnings before interest, tax, depreciation, amortization. For biotechs, 1.5. What this means, we like to see no more than 1.5 years for the company to pay off all their debt, net of cash on hand. And therefore, 2021, it's been below that, but 2022 and expected 2023 is right there along that line. So do bear that in mind, as that will impact, as we can see here, the dividend safety score. But so far, nothing really to worry about, but we can see in 2019 it was considerably higher. So do bear that in mind when we get next year's data. Purely for information purposes on the right, 50% in 2022 of the company's financing was from debt rather than equity. As always, if you are enjoying the content, do hit that like button, do subscribe for continued content on the channel, and if you do want to grab a copy to run your own companies through this model, do check the pinned comment and description and grab a copy. Now, Graham's valuation for BMI, we have the earnings per share, growth rate per analyst estimates with the current yield on AAA corporate bonds at 4.81, giving an intrinsic value of just shy of $66, around 10% upside to the current trading price and well within that 52-week price range. We then move on to the multiples valuation model. Companies in a similar sector and size, Merck & Co., AbbVie, Amgen, and Johnson & Johnson, which I'm sure you've heard of. We have the stock price, earnings per share, PE multiples, average multiplied by the earnings per share to give a BMY stock price of $94. When we take a look, that's above the 52-week high, showing some strong signs for improvement and around 50% upside to the current trading price. Now, dividend discount model, we have the yearly dividends with a nice average growth rate of 7.4%. I've gone 5% forward looking, which I think is fair, probably also conservative, but if you wanted to justify a higher percentage, or even if you thought this was too high and wanted to go lower, do grab a copy of the model and play around to see what figures you would get based on your estimates and judgments. Now, based on 5%, the DDM price is coming to $79.80. Again, just there at the 52-week high, showing some very strong signs of upside to that current trading price. We then move on to the discounted cash flow model. Free cash flow year on year, average growth rate 27.5%. Analysts are estimating that to be significantly lower forward looking, so we have gone for around 1%, slightly lower than analyst estimate. With that discount rate at 8%, the present value of future free cash flows and terminal value are added together with the cash, subtract total debt, and we get to our equity value. Divide that by the shares outstanding gives a DCF price of $82. Again, significant upside to the current trading price, and we can see right there at that 52-week high. Now, the intrinsic value is the average of the four models we have just run through, and if you are enjoying the content, do smash that like button. It really helps out, and do hit the subscribe to join the community. Intrinsic value coming to $80.49. Now, current price around $61. As I always say, 10% margin of safety is my preference for a wide moat, strong financial metrics, and good forward-looking data. For BMI, I would justify a higher margin of safety, but for those looking at 10%, $72 would be your entry. For 20%, you'd be looking around $64, and for those who are wanting a bit more than 20, for 25%, your buy would be just $1 shy of the current trading price. So what this is effectively saying is if you were to enter around $60 to $61, you would be getting a margin of safety of 25% based on the estimates and judgments we have just run through. And in terms of the upside for Wall Street, they are forecasting the price over the next 12 months to hit around $74.50, again showing significant upside to the current trading price. As always, let me know your thoughts in the comments. Are you looking to buy or even looking to sell, or purely on the sidelines speculating? Don't forget to like, subscribe, join the community, grab a copy of the valuation model in the pinned comment if you want. And as always, have a great day and catch you on the next episode. Bye-bye for now.